Thinking of starting your own business? One of the first and most important decisions you'll make is choosing the right structure. And for a lot of entrepreneurs, that means forming an LLC, a limited liability company. But what is an LLC exactly? It's a business structure that combines the liability protection of a corporation with the flexibility and simplicity of a partnership. In other words, you get to protect your personal assets and manage your business in a way that works for you. In this video, we'll walk you through how LLCs work, why they're so popular, and what you need to know before setting one up, plus a few tips that are useful even if you already have one set up. Let's start with the basics.
So, what makes an LLC stand out from other business structures? Here are a few of the main benefits. Limited liability. This is the big one. If your business runs into legal or financial trouble, your personal assets, like your house, car, or savings, are protected. Flexible management. Unlike corporations that require a board of directors and related requirements like board meetings and meeting minutes, LLCs let you decide who's in charge. You can manage it yourself or bring on managers, totally up to you. Pass through taxation. By default, LLCs are treated as pass through entities. That means the business itself doesn't pay federal income taxes. Instead, profits or losses are passed directly to the owners and reported on their personal tax returns. This setup helps you avoid what's known as double taxation, which typically applies to corporations. In double taxation, first, the business itself pays taxes on its profits, and then the owners pay taxes again on the distributed profits they receive. With an LLC, that double layer of taxation is avoided. For example, if your LLC earns $100,000 in profit, that income goes straight to your personal return, and you pay taxes on it just once as an individual. However, if it better suits your financial or operational goals, you can elect to have your LLC taxed as a corporation instead. Easy formation and operation. LLCs are relatively simple to set up. File some paperwork with whichever state you're operating in. Create internal rules of the LLC, which we'll explore in more detail later when we discuss the operating agreement, and you're off and running, without all the formalities that corporations deal with. Okay, now that we know what an LLC is and why people like it, let's see how it stacks up against the other major business structures out there: sole proprietorships, partnerships, and C corporations. Each structure has its own pros and cons depending on how you want to run your business, handle taxes, and manage liability. We'll break it down by a few key features: liability protection, taxation, raising capital, and what each is best suited for. First up, liability protection. LLCs and C Corps both offer strong protection. Your personal assets are safe if the business gets sued or owes money. In partnerships, there is typically no limited liability protection. The partner's assets are at risk. There are specific types of partnerships called limited partnerships, which may afford some, but not all, partners' liability protections. Sole proprietorships, no protection. The owner is personally on the hook for everything. Next, taxes. C Corps are taxed twice, once on the company level, then again when profits are paid to shareholders. LLCs, partnerships, and sole proprietorships all have pass-through taxation. That means profits go straight to the owner's personal tax returns, skipping corporate tax altogether. LLCs do get the option to be taxed like a corporation if it makes sense financially. We recommend speaking to an accountant to assess which makes most sense for your business. What about raising money? C Corps win here. They can issue stock and are the preferred structure for venture capitalists. This structure is perfect for startups aiming for rapid growth and external investment. LLCs have it tougher. Raising money as an LLC is slightly harder compared to a C Corp when it comes to attracting venture capital. But LLCs can still issue equity to investors and are credible with traditional lenders like banks. Partnerships are harder to fund due to limitations on transferring ownership interests, but can bring in new partners for funding. Sole proprietors have the hardest time. You're relying mostly on the owner's personal credit and resources. And finally, who's each one best for? C Corps are ideal for startups aiming to raise venture capital or go public. LLCs work great for small businesses and freelancers who want flexibility. Businesses can always start out as an LLC and then convert to a corporation. Partnerships are great for co owners and who want to share the load. And sole proprietorships are simple and perfect for solo business owners who are just getting started. Now, you might be wondering, what if you start out as an LLC, but later want to become a C Corp for funding reasons? That's actually pretty doable. Converting from an LLC to a corporation typically involves filing some paperwork like articles of incorporation, setting up bylaws, and possibly getting a new tax ID. You'll also need to shift your business's assets and liabilities over and check your state's specific rules. Different states have different rules for conversion. It's not too complicated, but it can come with some costs or tax implications. So it's a good idea to consult with a lawyer before making the move. So, if you're thinking ahead and planning for growth, it's helpful to know that your business structure isn't set in stone. Whether you're launching a tech startup, running a family bakery, or freelancing full time, understanding entity differences can help you choose the right legal structure to set your business up for success. So, what's the right structure for you? It really depends on your goals, how much risk you're taking on, who's involved, and how you want to handle taxes. Up next, we'll talk about how an LLC can be run.